This week, the Federal Reserve makes a decision that gets far less attention than it deserves, and if you carry a credit card balance, it affects you more directly than almost anything else in the news. On July 28 and 29, the Federal Open Market Committee meets to decide what happens next to interest rates. Right now, the federal funds rate sits between 3.50 and 3.75%, and inflation is running at 4.2%, well above the Fed's own target. Under the Fed's new chairman, Kevin Warsh, something has shifted. Just months ago, markets were pricing in rate cuts. Now, forecasters are bracing for the opposite. Bank of America projects 3 separate rate hikes before the end of the year. Deutsche Bank forecasts 2. The direction of travel has reversed. Here's why that matters to your wallet specifically. Most credit cards carry a variable APR, tied directly to the prime rate, which moves in lockstep with the Fed's target rate. When the Fed raises rates, your card's interest rate doesn't wait for a new statement cycle to catch up. It moves with it, automatically, whether you noticed the news or not. And the starting point is already the worst it's been in years. Americans collectively owe $1.25 trillion in credit card debt, a record. The average cardholder carries a balance of $6,519, up over 2% from a year ago. The average APR across all accounts sits near 21%. And serious delinquency balances more than 90 days late just hit its highest level in about 15 years. 111 million Americans currently carry a balance they cannot pay off in full each month. For all of them, every basis point the Fed adds isn't an abstract headline. It's a slightly bigger number on next month's statement, compounding daily, for as long as the balance exists. None of this means panic. It means paying attention to something most people scroll past. If a hike goes through this week or later this year, it typically shows up in your APR within 1 to 2 billing cycles, not instantly, but fast. Checking your current APR now, before any change lands, gives you a real number to compare against later. If you're carrying a balance, the math favors moving faster, not slower. Paying down high APR debt before a hike compounds it further is worth more than the same payment made after. And if you're considering a balance transfer or a lower rate personal loan to consolidate, locking in a rate before the Fed's decision rather than after is worth comparing. 3 things to watch this week. The Fed's decision lands July 28 to 29. Most forecasters expect a hold this time, but the trend for the rest of the year has shifted toward hikes, not cuts. Your card's APR moves with the Fed automatically, usually within 1 to 2 statement cycles. And with 111 million Americans already carrying a balance at a 15-year delinquency high, the cost of waiting is no longer theoretical. The headlines will cover the Fed's decision either way. What they won't tell you is exactly how it lands on your own statement. Now you know where to look. We track the financial events that actually move your money so you're never caught off guard. If this helped, subscribe. We post every week. I'll see you in the next one.